Hi, thanks so much for joining in. This is the Mutual Fund Show on NDTV Profit, and I'm Alex Matthew. This show gets you actionable insight on everything mutual fund related. Now, in the recent past, we've had a number of conversations about passive investment strategies. These are mutual fund schemes where you don't have active intervention by a fund manager. One of the subsets of these passive strategies is something called Smart Beta. The latest offering in that space is the Mirae Asset Nifty Smallcap 250 Momentum Quality 100 ETF. It's a passive strategy that places two filters, momentum and quality, and it's also a bit of a mouthful. Don't worry, we'll explain everything so that it's simple for you to understand. At the onset, we're joined by Siddharth Srivastava, the head of ETF Products at Mirae Asset. Thanks so much, Siddharth, for taking the time. Like I said, it's a bit of a mouthful. Let's understand what this is entailing, what does it mean, and how an investor should understand how this works. So let's start with the overarching theme, which is it's a smart beta product. Can you explain that first, and then we'll delve into this product specifically?
I think smart beta makes it sound complicated than it actually is. The idea is to target a very specific behavior or a profile. So for example, there is a factor called low volatility, where the idea is to have a portfolio which exhibits less volatility by picking up companies which have lower standard deviations compared to the similar companies in a given market cap segments. Then there is factors like quality, then there's factors like value, growth, momentum, where idea is to capture companies which are doing well from a stock returns point of view compared to the other companies. So in smart beta, also known as factor investing, the companies are picked based on a certain factor like quality, value, momentum, and they are even weighted in the portfolio based on those factors. So idea is that, let's say, instead of investing in Nifty 100, some people might come and say that I want to invest in a large cap portfolio which is, let's say, more stable or less risky than a Nifty 100 itself. So there he or she can invest in, let's say, Nifty 100 low vol 30, where 30 companies are picked based on less volatility. Similarly, a person may come and say that I want to invest in a portfolio of large cap companies where potential of returns is high. I'm okay with higher risk. Then he or she can invest in, let's say, a momentum 30 ETF or an index fund where 30 companies are chosen which are performing well. The idea is to capture that recent trend, but in the long term, hopefully it will outperform, but there is obviously phases of higher volatility. So factor investing is all about targeting a certain behavior, a certain profile which you want to from a asset allocation point of view.
So let's explain this even further, right, Siddharth? So because this is a passive strategy, we're talking about no intervention from a fund manager, and it's a very clearly defined strategy. So there are certain rules that come into play. You've called them factors, and they are called factors broadly, right? So, but we are defining the boundaries of this. So we're saying 250. That is the small cap 250 is the wider boundary, and we're talking about the smaller boundary, which is 100 stocks out of this 250 are selected, and there are two filters that are given, which is momentum and quality. So to explain this further, explain why you have selected first of all the 250 small cap 250, because this is the broader end of the spectrum and you generally see quite a bit of volatility in this space.
Absolutely. I think you've asked the right question. And just to build on to what I was saying earlier, let's say typically when people invest in small cap segment, they are sort of concerned about or they want to target stocks or portfolio uh, which have good liquidity so that they don't face issue while investing or while redeeming. They obviously want to achieve higher returns. So momentum is one of the factor, and they want to do all this with a with a quality portfolio, right? Quality is more of a concern in small cap and micro cap segment compared to, let's say, a large cap segment. So what we have done is, and obviously NSE has come out with this index, that instead of simply launching a small cap 250 ETF where you have exposure to all 250 stocks, here filtration is taking place. That first, all the illiquid companies will be excluded, all the companies which have higher promoter pledging will be excluded, and then 100 companies which are performing better on quality metrics as well as momentum metrics will be shortlisted. So ultimately, the final portfolio will be of 100 stocks where sorts of these filters are used, or rather, these factors are used to create the final portfolio. So idea is that hopefully through this portfolio we'll be able to capture the upside momentum, because we are using momentum as a factor, and provide some sturdiness whenever there is, let's say, a market correction, or
Right.
let's say
Si-
a longer phase of.
Sure.
Yeah.
So, Siddharth, I want to understand these two factors and how you've defined them. There are obviously certain very quantifiable rules that you've set that will help you understand which stocks qualify, right? So, first explain momentum. What is the definition of momentum when it comes to this particular scheme?
So all these factors have been well researched and they have been used on the active side. And as you mentioned, that they are now defined in a very rule-based manner to shortlist stocks. So momentum, for example, is defined as risk-adjusted momentum. So whatever the return stock is generating in, let's say, last 6 month or 12-month period, divided by the risk or volatility which that stock is generating. So it's simply return generated per unit of risk.
A little complicated. So, would it be possible for you to break it down for us even further? Uh, I'm understanding momentum as a stock that has outperformed or that has gained quite significantly over a period of time. And you have also said that this is also determined based on the risk involved, which is the volatility, right?
Absolutely. Let's take very simple example. Let's say there are three stocks,
Sure.
A, B, C. A and B have generated, let's say, 20% return each in last 12-month period, whereas C has given just 10% return. So for me, A and B has higher momentum, but within A and B, let's say B has higher volatility. It has sort of moved up and down more, right? Hence has exhibited more risk. So for risk adjusted momentum, you will end up selecting A, because not only it has generated higher return, but it has sorts of exhibited lower volatility also.
Now, how do you define quality? Because quality and the way that I've looked at quality, it's always usually on the larger end of the spectrum, right?
Yes. So, quality again, there can be several ways to define it. But broadly, whenever you want to assess a company on quality metrics, you look at profitability, you look at financial health, and you look at earning stability. So, in this index, the profitability is defined by return on equity. Uh, the financial health is defined by leverage, which is debt to equity ratio, and earnings stability is sort of defined by how stable the EPS has been in last 6 years. So again, a bit technical, but if you just focus on three factors, that you're using profitability, financial health, and earning stability as a metrics to gauge how sturdy a company is, then that is used to define a quality for a company.
Okay. So, and in fact, that was actually quite easy to understand. But the last aspect is, I'm sure when you're launching a product like this, you've back tested it. The benchmark in this case, I would think, would be the small cap index. So, against that, how is this strategy, or how would this strategy have worked?
So basically, as I mentioned earlier, that momentum typically performs better in a bull run, whereas quality typically shows sturdiness, stability in bad market times, right? Especially when there is a reasonable correction. So by mixing momentum and quality, the idea is to capture a bit of upside momentum and ensuring portfolio sturdiness in bad market phases. And that is what we have seen in the back testing. It outperforms the the broader segment in almost 16 out of 18 calendar years. It gives that consistent 7 to 8% alpha for a investment horizon of 3 year, 5 year consistently. But as I mentioned, that more stark observation, and which is why we are coming out with this fund, is that it not only captures the upside momentum but provides sturdiness during bad times, and sorts of it's in an all-weather portfolio. It also outperforms surprisingly 80% of active small cap funds in last 1 year, 7 year, and 10 year horizon. So while it's a passive scheme, it is doing fairly well when it is being compared to active schemes as well.
Absolutely. All right. Thanks so much for joining in, Siddharth, and breaking that down for us. Viewers, let's delve a little deeper into this and see where this fits into your portfolio. As Siddharth pointed out, there are quite a few time frames in which this has beaten even the actively managed funds. Now, we've been speaking about the Mirae Asset Nifty Smallcap 250 Momentum Quality 100 ETF. And while that sounds like a mouthful, we have actually broken it down for you so that you understand what this is all about. The question is, where does it fit in your portfolio? And we've got Amit Biwalkar as well as Salonee joining in, Sanghvi joining in to give you some perspective on all of that. Now, we were speaking with the fund manager of this particular ETF, and he was explaining how this works, but I'm curious what you make of this as well. So Salonee, first I'll come to you. The combination of momentum as well as quality in the broader market space, not something that we've seen very often. What do you make of it?
So I think momentum essentially means buying stocks that have performed well recently, assuming that the outperformers of the recent past are also going to be outperformers in the future. It works mainly because of investor behavior, where once a stock starts doing well, a lot more people then want to invest in that. But a momentum strategy by itself can have higher drawdown, especially in a turbulent market. On the other hand, you have quality, which essentially involves investing in profitable, stable companies with strong balance sheets. And high quality companies are actually stable, especially during bear markets. So momentum helps you capture the short-term gain, whereas quality gives you long-term stability. I think concentrating only on one factor can backfire, especially if the factor goes out of favor. So multi-factor strategy that combines both of these factors could actually provide alpha while still maintaining the downside, and is better than concentrating only on one factor.
Got it. Amit, according to Mirae, and I've seen the presentation, seemingly this is the case in certain time frames, and they're talking about 1 year, 7 year, 10 year, it has outperformed quite a large chunk of the actively managed funds. It seemingly beat the benchmark as well. But is it that simple an answer that, they back tested it, it works, buy it in your portfolio? What should an investor bear in mind?
Basically, all these data, what every presentation has on the factor investing are all backdated. They are not tested live for data. So you have to actually see as to how the fund is going to perform in a live market with live money. To understand this, Alex, I think we have to understand what is beta, and beta means the Sensex or the Nifty return, basically the index return. And when you say a smart beta, it means that out of the design, which is of fixed weightages of stocks, you will select something and assign it weights which are different from the market. So when you combine these 3-4 factors, like currently we have momentum and quality. Momentum is based on past performance, and quality is based on the ROC, ROE of those companies what you are going to select. So if you have multiple factors which are going to go in a fund, like say low volatility or growth or quality or momentum, then it creates a lot of confusion. People who come into mutual funds, they generally come for, one who comes into a mutual fund is somebody who says that I don't know, let the fund manager take a call. Now, if you want to enter a passive fund, but with the active fund management approach through factor investing, then those kind of investors, Alex, should go into such kind of smart beta funds.
Okay, fair point. The question then arises as to how much of an allocation can go into this? Because Salonee, you pointed out that the design of this particular strategy is supposed to give you the best of both worlds. While the markets are going up in a bull market, it's supposed to give you outsized returns, and it's also supposed to protect your downside because it invests in quality companies. The question is, it's still a broader market fund, and so therefore the risk involved is significant, and I'm pretty sure that this will be a high risk fund like most equity funds are. So how much of an allocation is appropriate?
I think first one needs to look at their asset allocation based on their risk-taking ability and the duration of holding, and decide if small cap as a category even fits within their portfolio, because small cap is not a category that every investor may want to invest in. But if we look at within the small cap allocation, I think one can look at about a 25 to 30% allocation towards such a strategy within the overall small cap allocation. Just one thing is that, before investing, it's important to understand that different factors work differently in different market conditions. And, the effectiveness of such strategy, again, as Amit mentioned, since it's back tested, depends on the effectiveness of those factors in live market and the ever-changing correlation with the market. So again, I would only look at this for, since it's an aggressive strategy, I would only look at this for somebody who has knowledge and who understands how the different factors work, and not for someone who's looking for income or capital preservation.
Fair point. All right. I've got a few questions, and by the way, that number on your screen is meant for you to send messages to us on WhatsApp, and we can take all of those questions. We've got a couple of questions which we will take today. The first one is from Narayan. He says that he is aged 47 years and he's got an SIP of 1.5 lakhs in HDFC Balanced Advantage Fund to balance the volatility, he says, in his portfolio. He's got as much as 2.24 crore in a PMS, and he's looking to achieve a minimum corpus of 4 crore before he retires in 4 years. So I'll come to you on this one, Amit. It's a little bit challenging, I'm sure, because you don't have his entire details, but the question is, has he invested in a good balanced advantage fund?
So I think balanced advantage funds give you asset allocation mix according to the structure of the portfolio. So in case of any of the balanced advantage funds, you need to look at what is the objective of that fund, whether they can move between debt and equity as per your requirement, and whether they are actually protecting your downside when markets actually turn negative. In a interest rate scenario going forward, Alex, where you will see that interest rates might come down over the next 2-3 years, having a 30-40% allocation to debt in a portfolio will not hurt, and you are accruing at a good 7% today. So if you have a fund which has a combination of debt and equity, where your debt also might give you at that 7-8% kind of return over the next 3-4 years, and plus you will be protected from volatility if the markets turn bearish, and you have an inbuilt insurance by having debt as well as equity in a single portfolio where your taxation also is taken care of, I think balanced advantage fund fits the bill. So that was to that question, whether A fund is better or B fund is better. I think over a long period of time, all the funds actually typically return over the same period absolutely similar returns. Okay, so it's more to do with the objective of the fund and how it has managed volatility in the recent past. If you look at March 22, March 23, index was at the same level. So you should actually gauge the fund, how is it doing in a flat market, in a bear market, and in a bull market, and then take a call on that.
Fair point. And your point on the potential for returns in the fixed income component of the balanced advantage fund, given the potential for the change in the interest rate scenario, Amit, is well taken. Thanks so much for joining in, both Amit as well as Salonee, and for giving us a breakdown, in fact, on the momentum quality strategy that has been launched by Mirae Asset. Now, we were only able to take one question today, but we should be able to take more tomorrow, so don't hesitate to to send your queries to us on that number on your screen. In the meanwhile, that brings us to the end of this particular edition of the Mutual Fund Show. It's been an absolute pleasure bringing it to you. Do stay tuned, lots more coming up over the course of the day, and this is NDTV Profit.